Kenyan banks are in for a tougher year, it seems. At least that's the word from Renaissance Capital. They believe that the reality of tighter monetary policy, rising non-performing loans will affect the outlook for 2012. Nothando Ndebele, she's head of Sub-Saharan African Research at Renaissance Capital. It's always great having you, Nothando. So firstly, your outlook, your overview of the banking sector in Kenya in the year ahead.
You know, we think it's going to be a challenging year. 2011 was a pretty good year for the banks when you look at the results. From a loan growth perspective, we saw loan growth up 38% September. So for the full year, we're looking at probably over 40% credit growth. This year, we're looking for credit growth to slow to about 10%. And with that, we expect that, you know, the banks are going to see a weakening in terms of the quality of their loan books. So we're looking for non-performing loans to increase.
Obviously, loan growth was predicated on lower interest rates until the last couple of months of 2011, when the CBK started to panic on a weakening shilling and rising inflation. That's obviously going to have bearing, as you're suggesting, in the year ahead. How big a bearing?
Now, I think it will have a big bearing. We've done some work on the affordability of new loans, and you'll find that, you know, a 10% increase in interest rate tends to increase the repayments significantly, especially at the low end, where people are facing challenges on their disposable income, etc. The good news is that we don't think high rates will be maintained for long. You know, inflation is starting to come down, and if you look at the MPC meeting decision in January, they decided not to raise rates further. So we would be looking for interest rates to start coming down in the second half of this year, but we concede it could be as early as the second quarter of this year. And that would give some reprieve, obviously, to the customers.
Okay, so these high interest rates would only be short-lived, but what will their impact be by way of delinquency and non-performing loans?
Yes, there's always a lag in terms of delinquency and non-performing loans. We expect those to start coming through probably in the second half of the year more significantly. Last year, you know, by September, the sector was at NPL ratios of about 5%, which is quite low. We're looking for that to rise about 300 basis points to 8% this year. So we are looking for a deterioration.
Efficiency of managing balance sheets, that really hasn't been a big problem for Kenyan banks. It's more a problem for Nigerian banks. But will bank managers be able to keep profitability up, keep risks at bay?
You know, we think they will definitely face challenges this year in terms of profitability. We don't necessarily see the big banks going into losses, and we don't see the scale of the problem being as large as what we saw in Nigeria. The Kenyan banking sector is well capitalized. It doesn't have the huge legacy NPL issues that Nigeria has faced since 2009.
All right, so, you know, when you look at the stock exchange, the banks continue to be attractive performers, but more so the tier one banks or the blue chip banks, KCB, Equity Bank, for instance. The smaller banks, the cooperative banks, tend to struggle a little bit because obviously they're not as well capitalized as the bigger banks, and they're lending to niche sectors like agriculture or SMEs or what, you know. So comparatively speaking, which banks will thrive and which will have a harder time?
I mean, we kind of look at a couple of things. One is on the funding side. So we look at pressures on their net interest margins. The good thing about the bigger banks is that they have, you know, a lot of retail networks in terms of branches. So they're exposed to cheaper deposits. So that will give them some flexibility in terms of their pricing. The smaller banks, which are more exposed to fixed deposits, they're facing rates of up to 30% for some of those banks. So you'll see those pressures coming through. So generally, the bigger banks are better placed to perform in a tightening environment. But we think, you know, on top of that, the bigger banks are more liquid, etc., which is why you tend to see more action out of them on the stock market.
There is also the case of the shilling, Nothando, which depreciated over 25% last year. It's really been the target of monetary policy to stabilize the shilling, get it a little bit stronger than what we've seen. This has really resulted in losses on the forex side, and a lot of third quarter results reflected that a lot of banks were hit on trades of foreign exchange. How will that impact banks this year?
Well, we saw some interesting results there. I think that probably the biggest impact is more on the fixed income portfolios rather than just on trading the currency. Because with the fixed income portfolios, you've seen treasury bills going up again, significantly following what the interest rates have done. So banks who have fixed income portfolios, which are classified as available for sale or trading assets, have had to take mark-to-market losses. The ones that already had these assets classified as held to maturity have not had to take these adjustments. So that's where we've seen most of the movement in terms of trading income.
Okay, let's talk about those who invest in Kenyan banks. What would your recommendations be? What would the strategy need to be in this changing environment?
Well, in our view is that a lot of the bad news has already been discounted. On top of that, our view is that interest rates have peaked and that we are likely to see interest rates starting to decline, as we said, probably second half of the year, but could be as early as the following quarter. We would say stick with the big banks, the one that have a good franchise, large, cheap deposit base, and the ability to reprice their loans on the other side. So we still favor both KCB and equity in these markets.